All right, we should be live. We'll wait for some viewers to get going here. 10th of December, and this is about day 3 of kind of learning about the log normal distribution, returns, and the normal distribution, and then we'll be kind of looking more at some returns data and how that relates to the normal distribution. So we'll get going a little bit here. We just have our chart up here, and as I kind of wait for some people to get in, we'll go over our market drivers list, and we can do an advanced view if we want. We can look at some percentage changes here. The VIX is in by 10%. We got the NASDAQ volatility in by 8%. Kind of find it weird how the S&P volatility is in more than the NASDAQ volatility, but maybe that's just a lack of understanding on my part. We got two-year yields. Two-year yields coming back from about 70 basis points, and they're into 65 basis points. We've got ETH. ETH is sub 4,000 right now, and that's at 3977, and that's a change of 3% roughly. We've got the pot sector doing what the pot sector does, down by 1.5% if you're judging it by the MJ ETF. The MJ ETF actually has some weird holdings and swaps that I need to look into. I'm not an investor into the ETF, but I do hold a good amount of cannabis stocks just for long term, but whatever. And let's see here. All right, yeah, we'll get going here. So we'll get back to kind of some market close details and things like that for the week ending here. And but first, we'll go into our study session and kind of learn more about some fundamental concepts before we get into the charts and stuff like that. So what we'll do here is we'll turn this on. Hopefully that will transition. Cool. And let's get going. So this is a segment from Julia. She's a really good quant over at Tasty Trade, and this is a really good piece relating to the normal distribution, and then she tied it into geometric Brownian motion and how that relates to S&P returns data. All right, so let's make it happen.
Means enough out of you. We're joined by Julia, and I've got the skinny on quantitative finance. How are you, my dear?
I'm doing great. How are you guys?
Doing good. Thank you for coming on the show.
Yeah, long time no see. We haven't had a SQF in a while or skinny on quantitative finance in a while, so this should be fun.
I'm ready. Sound enough? You ready to have some fun?
That's a light, fun piece. It's almost like a comedy routine.
It's okay. I would call it light. It's very conceptual, and I think that should be fun.
I'm telling you, you could do this in your stand-up act.
My stand-up, God, I've seen a few stand-ups recently, and like the thought of doing that on a stage just like scares the crap out of me. I can't.
Okay, all right, let's get into it because we want to be on time.
Cool.
As always, if something doesn't sound right or if something doesn't look right on the stream, I'm still figuring out some of the nuances of all the streaming software and stuff like that. Please let me know. Drop it in the chat. Throw it out on Discord. Yeah, just don't be afraid to let me know. All right, so let's go.
Okay, let's do it. All right, so this one, it's pretty conceptual. We're kind of looking at specifically the geometric Brownian motion assumption from the Black-Scholes model, and we're going to say, like, okay, so if this is true, what kind of implications does that have for us as traders? And then to what extent are those implications true based on kind of what we've experienced and what we can test? And specifically, we're going to be looking at the normality assumption and how we can kind of like approximately gauge the accuracy of that using some statistical tools called probability plots. So that's the kind of the long and short of it.
All right, let's do it.
Okay, cool. All right, so one of the core assumptions of the Black-Scholes model is that stock prices follow geometric Brownian motion with constant drift and volatility. So what exactly does this mean? How does it?
I just realized that this is off of an old link right here, so